Gold just surged past $4,800, and Goldman Sachs quietly raised its year-end target by $500. But the reason they did it should make you uncomfortable. Gold had surged more than 11% since the start of the year, extending a staggering 64% rally from 2025. Trading desks watched the climb. Retail investors checked their portfolios. And somewhere in Lower Manhattan, a team of commodities analysts at Goldman Sachs quietly revised their year-end forecast upward by more than 10%. The new target, $5,400 per ounce. The old target, published just weeks earlier in mid-December, $4,900. That's a $500 jump, not because the data changed, but because something Goldman had flagged as an upside risk in their original December outlook was now happening in real time. Private investors, the kind who manage family offices and institutional portfolios far from the noise of retail trading apps, were buying physical gold, and they weren't selling it back. Most people who follow markets saw the revision as bullish confirmation. Gold bugs celebrated. Skeptics rolled their eyes at another Wall Street forecast adjustment. But the revision itself wasn't the story. The story was what it revealed about how Goldman Sachs, and by extension, much of institutional finance, is reading the world right now. If you read Goldman's December 2025 macro outlook at face value, the message was clear and almost comforting. Global GDP growth would hit 2.8% in 2026, comfortably above the consensus forecast of 2.5%. The United States would substantially outperform, growing at 2.6% compared to a consensus estimate of just 2%. Inflation would fall back toward the Federal Reserve's 2% target by year-end. The probability of a recession in the next 12 months had dropped from 30% to 20%. Equity markets would deliver another solid year, 12% total returns on the S&P 500, driven almost entirely by earnings growth rather than valuation expansion. This was the language of confidence. Goldman's chief economist, Jan Hatzius, and his team titled their macro report, "Sturdy Growth, Stagnant Jobs, Stable Prices." The word sturdy does a lot of work there. It's not explosive or fragile. It's steady, reliable, something you can build on. The firm explicitly wanted to push back against what they called the "Is America on the Decline?" narrative circulating in certain corners of the media and policy world. Their answer was a firm no. Tax cuts would boost disposable income by roughly $100 billion, equivalent to 0.4% of total household income. Reduced tariff drag, meaning the tariff-related inflation pressures from 2025 would ease, would give consumers breathing room. Easier financial conditions, with the Federal Reserve expected to cut interest rates by 50 basis points total across 2 cuts in June and September, would lower borrowing costs. Business investment would get a lift from full expensing provisions. The pieces were all in place for a soft landing that actually stuck. And yet, if you kept reading, something else emerged. Underneath the optimism about GDP and corporate earnings, Goldman's analysts were sketching a much more uncertain picture. One where labor markets were softening in ways that didn't fit neatly into the sturdy growth frame, where private credit markets were showing stress, and where central banks and private investors were moving money into gold at a pace that suggested they didn't entirely trust the soft landing story either. Let's go back to that gold forecast. In mid-December, Goldman projected gold would end 2026 at $4,900 per ounce. The forecast was built on 2 main drivers: continued central bank purchases, averaging 70 tons per month, roughly 4 times the pre-2022 baseline of 17 tons per month, and a gradual recovery in Western exchange-traded fund demand as interest rates came down. Goldman estimated that central bank buying alone would contribute about 14 percentage points of price appreciation. But the December report also included a line about upside risk. Specifically, the risk that private sector investors, not just central banks, would start diversifying into gold as a hedge against what Goldman called global policy risks. At the time, private sector holdings of gold through ETFs represented just 0.17% of U.S. private financial portfolios, about 6 basis points below the peak from 2012. The sensitivity was significant. For every 1 basis point increase in the gold share of U.S. portfolios, driven by new purchases rather than price appreciation, Goldman estimated the gold price would rise by 1.4%. That upside risk started materializing almost immediately. By mid-January, the flows were unmistakable. On January 21st, Goldman's commodities team, led by Dan Stroven and Lena Thomas, published an updated note. The language was careful but direct. We believe that private sector diversification buyers, whose acquisitions mitigate global policy uncertainties and have contributed to the unexpected rise in our price forecast, will retain their gold assets through 2026, thereby enhancing the baseline for our price estimate. Translation: the private money that started buying gold wasn't flipping it for a quick profit. It was staying in. And that meant the starting point for the rest of the year was higher, which pulled the entire forecast curve upward. The new target? $5,400 per ounce by December 2026. Now here's where it gets interesting. Why would private investors, sophisticated institutions managing billions in assets, suddenly decide to load up on gold in an environment where Goldman itself was forecasting sturdy economic growth, falling inflation, and double-digit equity returns? If the macro picture is genuinely solid, gold should be a relative underperformer. It doesn't generate cash flow, it doesn't pay dividends. Its main appeal is as insurance against instability, economic, geopolitical, or monetary. The fact that these buyers were showing up and staying in suggests they're seeing something Goldman's base case macro forecast doesn't fully capture. Or at least they're hedging against outcomes Goldman rates as low probability but high impact. One possible answer sits in Goldman's own research on the U.S. labor market. The December outlook noted that while GDP growth would be sturdy, the job market would be stagnant. Unemployment was projected to stabilize around 4.5% through 2026, up from 4.1% in mid-2025 and 4.6% in November 2025. On the surface, that's still a relatively healthy level. Historically, unemployment below 5% signals a tight labor market. But the details were less reassuring. Chief U.S. economist David Mericle wrote in mid-January that the labor market is the most uncertain piece of the 2026 outlook. Job growth had weakened substantially in 2025, and much of that decline wasn't just about reduced labor supply from lower immigration. Underlying trend job growth, Goldman's estimate of how many jobs the economy was organically creating each month, had fallen to just 11,000 per month. That's below the roughly 70,000 jobs per month needed just to keep the unemployment rate stable given current labor supply trends. Goldman's baseline assumption was that improved economic conditions and more supportive policy would boost hiring enough to stabilize things. But they also acknowledged a plausible alternative scenario, a period of jobless growth, similar to the early 2000s, where GDP expanded but employment didn't. The risk factors were stacking up. Job openings had been trending slowly lower. Companies were increasingly discussing layoffs in earnings calls. And more than a few were expressing eagerness to deploy artificial intelligence tools to reduce labor costs. Here's the uncomfortable part. If productivity gains from AI and other technologies arrive faster than expected, something Goldman flagged as a real possibility, companies could hit their revenue and earnings targets without adding jobs, or even while cutting them. That would be great for corporate profit margins and equity valuations in the short term. But it would also mean more workers losing income, weaker consumer spending over time, and rising political pressure on policymakers to do something. This is the kind of scenario that doesn't show up in a base case GDP forecast, but it sits in the back of the minds of people managing large pools of capital. And it's exactly the kind of uncertainty that makes gold look more attractive, even if the official recession probability is only 20%. Goldman's forecast for Federal Reserve policy shifted noticeably between December and mid-January. The original December outlook called for interest rate cuts in March and June 2026. By January 12th, those cuts had been pushed back to June and September. The reason? Even though the labor market was softening, inflation was still running above target, and the Fed needed more time to gain confidence that price pressures were genuinely easing. The revised forecast called for two 25 basis point cuts totaling 50 basis points, bringing the federal funds rate down to a terminal range of 3.0 to 3.25% by year end. That's a cautious, deliberate pace, what Goldman characterized as the Fed meeting in the middle between competing pressures. On one side, a labor market that's cooling and could deteriorate further. On the other side, inflation that's still elevated and vulnerable to upside surprises, especially if tariffs or other policy changes add cost pressures. The delay in rate cuts matters for two reasons. First, it means borrowing costs stay elevated for longer. Consumers continue facing higher rates on mortgages, auto loans, and credit cards. Businesses delay major investments because financing is expensive. Economic growth stays positive, but the margin of safety shrinks. Second, it signals that the Fed itself isn't entirely confident in the soft landing narrative. If officials were truly convinced that inflation was on a sustainable path back to 2% and the labor market was merely stabilizing, they'd be cutting sooner. The fact that they're waiting suggests they see meaningful risks, either that inflation proves stickier than expected or that cutting too early would reignite price pressures they've spent years trying to contain. Goldman's economists noted that market futures pricing had shifted dramatically. The probability of a January 2026 rate cut had collapsed from 11.6% to just 4.8%, while the odds for a March cut fell to around 30%. June became the most likely starting point. That's not just Goldman revising its forecast. That's the entire market repricing expectations based on incoming data and Fed communications. The credit market warning. Buried in the research was another tension point: private credit. Goldman noted that approximately 15% of borrowers in private credit markets were no longer generating sufficient cash flow to cover their interest payments. These weren't marginal companies in distressed industries. These were borrowers across the private credit ecosystem, which had grown explosively in recent years as institutional investors chased yield in an environment of ultra-low rates. The problem was structural. Many of these loans were originated when interest rates were near zero. When rates surged in 2022 and 2023, borrowing costs spiked, but the underlying businesses didn't suddenly become more profitable. Cash flows stayed flat or declined, while debt service costs doubled or tripled. By 2026, even with the Fed starting to ease, the damage was done. Goldman's analysts noted that even potential rate cuts would only slightly alleviate pressure rather than address fundamental weaknesses. This is important because private credit has become a massive piece of the financial system. Trillions of dollars in loans extended by non-bank lenders to companies that couldn't or wouldn't access public bond markets. If 15% of those borrowers are already struggling to service their debt before a recession, what happens if growth slows more than expected? What happens if unemployment rises to 5 or 6% and consumer spending weakens? Goldman's base case didn't assume a wave of defaults. They projected credit default rates around 2% in 2026, well below the historical average of 4.5%. But that forecast was anchored to their sturdy growth scenario. If growth disappoints, if that 20% recession probability becomes 40 or 50%, the credit stress could escalate quickly. What to watch next? So what are the actual signals to monitor? Goldman laid out several. First, the January delivery cycle in COMEX gold futures and whether inventory levels start converting from eligible to registered status. That's a technical detail, but it matters because it would indicate whether physical demand is tightening supply in ways that could push prices higher still. Second, the next Bank of England monetary policy announcement and whether London Vault withdrawal times, currently running at 8 weeks, extend further. If they do, it would confirm that physical gold demand is outpacing refining and logistics capacity, which would widen the spread between futures prices and physical prices even more. Third, central bank purchase announcements. At current prices above $4,900 per ounce, the math for emerging market central banks changes. Many have stated goals of raising gold to 10% of total reserves. At $5,000 per ounce, hitting that target would require roughly $194 billion in purchases, or about 1,200 tons of physical gold, roughly 1.5 years of current purchase pace. If those purchases accelerate, physical supply tightens further. If they slow because price becomes prohibitive, that's a signal that the momentum behind the rally is exhausted. Fourth, U.S. employment reports. Goldman expects the unemployment rate to stabilize at 4.5%, but they've explicitly flagged the risk that it could rise further if AI-driven productivity gains arrive faster than expected or if companies accelerate cost-cutting. If monthly job creation stays below 70,000 and unemployment ticks up to 4.7 or 4.8%, the Fed would face intense pressure to cut rates more aggressively, or risk being blamed for pushing the economy into recession. Fifth, inflation data, particularly core PCE and core CPI. Goldman forecasts core PCE inflation falling to 2.1% by December 2026, and core CPI to 2%. If that happens, it validates the entire soft landing thesis. If inflation stays sticky above 2.5%, the Fed stays on hold longer, financial conditions tighten, and the margin for error shrinks further. The quiet truth. The setup Goldman Sachs is describing, sturdy growth, falling inflation, modest Fed easing, double-digit equity returns, is entirely plausible. The forecasts are grounded in reasonable assumptions about policy, productivity, and consumer behavior. But the revisions tell a different story. The delay in Fed rate cuts. The downward revision in recession probability that still leaves it at 1 in 5. The upward revision in gold prices, driven by private investors hedging against policy uncertainty. The warning about private credit stress. The acknowledgement that labor markets could deteriorate faster than expected. These aren't contradictions. They're reflections of a world where the base case is positive, but the distribution of outcomes is wide. Where things could go right, but there are multiple ways they could go wrong. Where rational, well-informed people with access to the same data can look at the same economy and reach different conclusions about what to do with their money. Gold at $5,400 by year end isn't a forecast of collapse. It's a forecast that uncertainty stays elevated, that policy risks remain, and that enough investors with enough capital decide they'd rather hold an asset with no yield than take the risk that the sturdy growth scenario doesn't pan out. Right now, the system is holding together. Growth is positive. Inflation is declining. Equity markets are near all-time highs. But the cracks are visible if you look. And the smart money, the kind that moves slowly and thinks in decades, is buying insurance.